Good morning. Tristan here with your market update. Last week saw volatility rear its ugly head as markets around the globe suffered major pullbacks. The Nasdaq, which is already coming off a string of weekly losses, is now in correction territory. The tech-heavy index is now down over 10% from its previous record close set in July. It lost another 3.4% last week. The S&P 500 dipped 2.1%, while even the Dow saw its winning streak snapped with a loss of 2.1%. Futures are indicating that this sell-off is likely to extend into today. We do anticipate volatility to continue in the near term. Traditionally, August through September is a turbulent time for equities, so the timing of this pullback does not come as a shock. While this pullback may be uncomfortable in the near term, it's important to remember that market corrections are healthy and a normal part of market cycles. Data shows that going back to 1941, for years that the S&P 500 gained more than 10% in the first half, the average largest second half pullback has been 9%. Despite this, in nearly 80% of those years, U.S. markets were still able to generate second half gains. Much of this market pullback was triggered by a weak jobs report for July. Data showed that the U.S. economy added 114,000 jobs last month, much less than the projected 175,000. The unemployment rate also jumped to 4.3%. These figures have generated increased concern that a recession may be looming, but have also increased the likelihood of a large interest rate cut at the next Fed meeting. Futures contracts pricing are now indicating a 97% chance that the Fed cuts its benchmark rate by a full 0.5% in September rather than only a quarter point. Another factor influencing this recent global equity pullback has been the unwind of the Japanese yen carry trade. With the Japanese raising interest rates last week, the yen has surged in relation to the US dollar, making it more expensive now for investors to borrow the yen and reinvest those funds in a currency paying out a higher rate of return. Global investors are now being forced to sell other assets, specifically equities, to repay their yen debt before taking even more substantial losses. Thank you. Have a great week.